Looking at some of the fundamentals going into the fourth quarter of 2022, with rising interest rates, many are now penciling in a potential recession in some of the major Western economies as the interest rate picture drives up. There seems to be no let-up in the problems that it's bringing about. Of course, central banks only have one view, and that is to tame this rampant inflation. But what about the technicals for the S&P 500 going into the back end of this year and into 2023? Let's pick up on that now with more technical analysis on the charts at the moment as we go into that Q4 period with Ron William from RW Advisory. Ron, welcome.
Hi there.
It's always interesting listening to some of these fundamental analysts talking about where we are, the economic fundamentals, how we're setting up in terms of poor earnings and so forth. But we don't often look into too much detail about the technicals. So let's pick that point up with you and ask you about how you feel about things as a technical analyst using the S&P 500. Just to outline how you're feeling about things going into Q4.
Well, as part of a blended approach, things are still negative and certainly rolling over as we see risk-on markets, I should say, turning back under the long-term strategic moving averages, the 200-day being a case in point. And if we look at the S&P 500 as that proxy, that's exactly what we see. We had the strongest bear market rally in line with what happens during a big bear. They're up 17 or so percent. The average is about 23%, but all beneath the 200-day moving average. So prior to that, when the market was trading above it, it was buy on the dip. Now it's sell on the rally, and certainly further downside to go back into the June low, which is the make or break level ahead.
It's interesting, isn't it? This the mechanics of a bear market rally. Keeping this chart up, and we had these record highs going to the beginning of this year for the S&P 500, and a lot of the major Western markets following this sort of pattern. In this case, it was a 23.5% drop down. I think the Nasdaq was down. It lost a third of its value, didn't it? The Nasdaq,
yes,
from the peak to the trough. But we had this bear market rally. Can you describe what goes on in the mechanics of a bear market rally in terms of psychology, how we approach the markets, and why there is this bounce? Because it is a false flag, isn't it?
Yes, it is. I mean, it's often called the dead cat bounce or the suckers rally, where basically there is a mean reversion from oversold conditions and a big buy on the dip community that is still calling the bull market revival. And during that time, the psychology is denial, essentially. But it's very difficult to time because is it denial for real? Is this cheap fundamentally, or is it cheap for a reason? These are all the big questions that get asked at this time. So it's only when you let the market decide which direction it wants to take. In a bear market, there's usually elevated volatility with lots of false signals. So caution is key, and risk management is everything. So here we are with the market telling us it's failing at the 200-day, which is key, and the rollover ahead.
Yeah. Okay. Well, let's move on to the next chart and talk about some of the macro sort of themes going on here. Just talk us through what you've got here. I referenced at the top about this inflation, which is, I guess, key to what's happening fundamentally. But I'd be interested to get your view on how this plays out technically.
Well, the approach is a blended approach of macro, fundamental, technical, but essentially at the heart of technical analysis is the perception of all of the above. And so if we look at what is key in terms of headline concerns, it is inflation. And we can see that there's still a surprise factor of inflation higher than expected. You can see there at 8.1%, and that did ignite the rollover further down, along with the technical bearish setup. What's interesting is if you look at the chart inserts on F2 and F3, F2 shows that even falling expectations of inflation is still bearish, because ultimately that's pricing in a contraction in economic growth, but then also further negative earnings and sales and all the other kind of weaker fundamentals for the market. So there we can see S&P 500 in orange, inflation break even in black. And then just for the big picture context, we can see historic inflation is still an issue, likely to be structural, but that won't be a straight line move, and certainly still a pressure point for many investors and traders.
I spoke at the top about going into Q4. There is a significance, isn't there, about this in terms of seasonality in the markets. Explain more about that using historical analysis, giving an indication as to how we should be positioned going into this last period of the year.
Yes, so seasonality is the baby cycle as part of that top-down market timing approach. It's the monthly performance of any market, particularly in the equity space. And we can see, looking at that, the pattern that we've discussed before, which is typically a sell in May and go away phenomenon. The worst of the moves is in June and September, as you can see there in figure 1, top left side. That has played out. Certainly June, as you can see in figure 2, top right-hand corner, was the worst on record, with a bigger drawdown in 2008 GFC and the 1962 Kennedy slide. What that means from a trading perspective is it created one of the biggest oversold bounces, bear market rallies, in line with what we typically see in a bear market, an average of about 20 or so %, which is what's happened. And if we look at the lower charts, figure 3, the timing was also on the mark in terms of the peak drawdown phenomena, and that happened in late August, early September, alongside some of those macro pressures triggering. And what's very interesting, of course, is that the last chart just showing that September, which is the worst of this pattern, is naturally going to be worse if things are bad or going into it. So here is statistical information showing that if we're below the 200-day moving average or year-to-date minus 15% or more, then naturally expecting same negative performance is more than likely, and a bull scenario is a close to impossible situation.
So it seems to me like you're setting us up for what is an opportunity, a big shorting opportunity in these markets. Is that the case?
It is. And what's interesting is the market is pricing this in. And so you can read it in either way. A potential contrarian trade ahead because it's overcrowded, or smart money, as in the case of the data that we're looking at in terms of the top left and right charts, are potentially in the money and acting as the lead indicator of further risk ahead. So figure 1 shows the big short positioning in futures market at historic lows. Figure 2 shows equity sentiment also at kind of dangerous extremes too. Ultimately, one of the ways that we can analyze this in an objective way is to run the stats and see what happens after we hit these extremes, and this has been done by industry research, and you can see here the drawdowns after futures hits a threshold of 250k contracts. When that happens, 6 months in, you can get a negative performance, but in particular in 2008 it signaled the 40% drop that were to follow. So this doesn't mean it's inevitable, but it does at least show that it is negative, that is the high probability, and that the outlier event was correctly signaled back in 2008. And what's important on this is, of course, many people are looking at other historical contractions in the market as potential analogs. 2008 is similar in terms of the price structure, and you can see that it's usually a 3-stage correction: a fall, rally, and then rest of fall. And we've already had the first 2 stages, with the third to follow.
Okay, well, let's put all this into some sort of context in what we were talking about at the start, and that is the S&P 500, and ask the question about how low it can go, given the context of what you've just been saying, where we are. We've had this bear market rally, which gives you that upward relief, which then takes out more people in the market. So this next leg down, what are your key points to watch out for on the way down from where we are?
So always the behavioral patterns and what they imply, but then also from the risk levels to watch out for, which every trader investor will want to look at. They're the same ones we reviewed last time, but with the updated data. We can see that last time we spoke was back in the June low, since we've had the strong bear market rally from oversold extremes and now the rollover. But essentially the levels are the same. The most important one is going to be the June low at 36.50. Thereafter, the 50% make or break level, and that's the halfway mark of the bull run from COVID-20 lows at 3,500. And then the pre-pandemic peak will continue to be a memory for the market that it will potentially visit, and if so, will create another pain threshold, and that's at 3,400. Further levels down below at 3,200 and 3,110 based on Fibonacci and Dow levels.
Keeping this chart up here because I want to analyse it in terms of the potential for there on down. You do talk about that, the recovery that we had on from the COVID lows. COVID lows are on the far left-hand side of that chart, all the way down there below the 2300. Realistically, is that an opportunity, do you think? Would you need to see a spectacular break of those levels you're talking about to get down there? Or could it be a slow grind?
Yes, so we could have a bear market sideways with elevated volatility or straight down. Not in a straight line, but certainly in a cliff drop manner. And we did see that in 2008. So the GFC of 2008 and then TMT 2000. There are other analogs that come to mind. So work on each of these scenarios. Currently, the base case is down. Best case is if we go sideways and oscillate around the 200-day, and certainly the risk or worst case would be a 2008 or 2000 cliff drop down.
Yeah. Okay. All right. Well, let's wrap all this up and ask the next question about we've spoken about this before. There's this Minsky risk pattern. Explain more about where you're going with this point about the Minsky risk.
Yeah, so originally developed by Hyman Minsky, the American economist, talking about what happens when bubbles burst on easy liquidity, rising interest rates, and runaway speculation, similar to where we are now. All I've done is combine that with a technical framework to try and study the behavioral patterns and the timing of the turns. And what's interesting is this expanding volatile pattern between 1, 2, 3, 4, 5, and 6. You can see there's higher peaks and lower troughs, which is the battle between buyers and sellers. That line in the sand is where we just retested and rolled over. So it was the long-term 200-day line at 43.03, but it was also this Minsky risk pattern, which I've been watching for some time now, further reinforcement that the risk is to the downside. There's a big bull trap that is being unwound, which creates forced liquidation. So people not selling things because they want to, but because they have to. And that chimes in with the bear market psychology, which is yet to unravel. So not all doom and gloom. It is something that it is a risk that we ultimately just have to factor in. And right now, there's the risk of a 20% drop into the pre-pandemic peak level. We should pace that trajectory step by step and reassess at each stage.
Of course, one has to also look at what happens thereafter. If you get these big declines, quite often it's quite cathartic, isn't it, for the market? It clears out all the debris at the bottom of the market, and then it gives an opportunity for people to buy back in. I guess it's just a question of having the right psychology, which is what we've spoken about before, about preparing yourself for the bottom to continue to contribute to a market which otherwise might be quite painful if it was to go sideways along the bottom. But most markets do then bounce, don't they, once they find a floor?
They do. They create the biggest buying opportunities in a lifetime. For those that are well positioned and certainly playing more on the defensive side and managing the risk. But most important is adapting to those changing market environments. So most of the clients I spoke to early this year were not doing that because it was quite a shock start to the year, juxtaposed to what we experienced in terms of the up moves and the limited volatility. So when that did change, the biggest issue was acknowledging that, adapting to it, and then of course revising all of the strategies. So I think most people are now aware with the first half of the year done and it being quite volatile. The question is what next? And I think certainly if we work on risk scenarios, that would be the best strategy going forward.
Okay, well look, as ever, Ron, it's a pleasure. Thanks indeed for joining us with this look at the technical analysis side of the story going into the fourth quarter. That's Ron William from RW Advisory.